We would like to apologise for the way in which politicians are represented in this programme. It was never our intention to imply that politicians are weak-kneed political time servers who are concerned more with their personal vendettas and private power struggles than the problems of government. Nor to suggest at any point that they sacrifice their credibility by denying free debate on vital matters, in the mistaken impression that party unity comes before the well-being of the people they supposedly represent. Nor to imply at any stage that they are squabbling little toadies without an ounce of concern for the vital social problems of today. Nor indeed do we intend that viewers should consider them as crabby, ulcerous little self-seeking vermin with furry legs and an excessive addiction to alcohol and certain explicit sexual practices which some people might find offensive. We are sorry if this impression has come across.
I'm so terribly, well, I'm not really. Good morning, good evening, good afternoon, and welcome to the Booms and Bus Show. My name is Jonathan Davis. Today is Monday, the 10th of July. I'm so glad I finally remembered to say the date that I'm recording this at the top of the show. I remember last week I didn't do it till I think the last 2 minutes or something like that. So that's when I'm recording, 10th of July. It's 11:30 in the morning. So if anything happens from about 12:30 onwards, and you're listening to it after that, and you're wondering why I haven't mentioned it, well, now you know the answer. The Booms and Bus Show, for new listeners, is about free market capitalism, and how avowedly we despise cronyism, socialism in all of its forms. Have you yet subscribed to the Booms and Bus Report? Why not, you naughty person, you? I feel like I'm going back to Monty Python here. In the Booms and Bus Report, which comes out roughly every couple of months, you get really great data and discussion of what is really going on. And as I've said previously, in the Booms and Bus Report, it gives you hard data that you can use in discussions with numpties who tell you that everything is okay and always will be. Have you ever been caught out in that situation where someone says something totally, utterly ridiculous, but you don't have a comeback? Well, get the Booms and Bus Report and you'll have all the comeback you ever want. So let's start off with looking at what's been happening over the last week out and about. I see that the Thatcher statue for Westminster has been, quote, postponed, unquote. Get this. In case it gets vandalised. Well, listener, if you think about that, we shouldn't do anything in case socialists decide to destroy it. It's the most ridiculous political argument I've heard, and I hear lots of ridiculous arguments. We shouldn't do something in case it upsets a socialist. For goodness sake. Get the statue out, get it up. She is the greatest Prime Minister this country ever had. In the 1980s, let me remind you, everyone's prosperity rose. Those who wanted to take part. Those who didn't want to take part, or who just wanted to complain about the system, well, the normal thing happened to them. Tough titty. What else? I see that the financial regulators have fined RBS, Royal Bank of Scotland, £2.2 million after it was found, listen to this, doctoring and forging signatures on insurance files. Have you never heard of the word fraud? Have you never heard of the word crime? Have you never heard of the words doing your blooming job, regulators? Yet again, we do not prosecute bank generals. And for the life of me, I don't understand why not, except that we live in a cronyist, quasi-fascist state. Look up fascism and you'll see I'm not exaggerating. I've got a lot to get through today, so I'm going to rush rather than dwell on many topics. Let me remind you that you go onto the Booms Busts Show Twitter feed at Booms Busts Show later today, and you will see the iTunes tweet of the show. Attached to the iTunes tweet of the show will be photos and charts that I'm talking about in the show. So if you are on your mobile device, by all means, you've downloaded the podcast. You can start listening to the show, but then go on to Twitter, go to @BoomsBustShow, find the iTunes tweet where I'm announcing the show, and there, while you're listening to the podcast, you can look at the photos and charts. And that's the same if you're actually listening to it perhaps on your PC via Audioboom or in some other way. There is the first photo. It is a photo of street picture, paintings using chalk of the flags attended, where they had attendances at the London Pride LGBT March. In there you see the Palestine flag. In Palestine, you LGBT socialist numpties, you would be put to death for being homosexual. And you've got the Palestinian flag at a pride march? Are you stupid or just mad? Here's an interesting stat for you, moving on. In 2015, it marked the first year in hundreds of thousands of years of human history, the year 2015, that the number of people over the age of 60 was greater than the number of children under the age of 5. Isn't that interesting? And there is a chart to show when the crossover took place. Fascinating. Now, there is another fascinating chart of the world map. You will see that most of the world, in fact, by the look of it, something like 85, maybe even 90% of all landmass is in grey. And then you've got from India across to the Pacific, so Southeast Asia, down to Indonesia, through Laos, Korea, up to the Philippines, is in red. The global population is 7.3 billion people. And that 10 or 15% of the landmass is more than half of the global population. Don't tell me that we should be focusing on America and the EU. Remember, part of this show, a big part of this show, is about helping you build a bigger retirement pot. So if you're going to put your retirement money to work, are you going to put it into the US or the EU? Or are you going to put it into emerging markets, particularly in Southeast Asia? Now, you know we hate socialism, and I've got some bad news for you. South Africa's ruling ANC party, which is only there because it did, no doubt, an astonishing, amazing thing. It got rid of apartheid. The problem is they're run by communists. The ANC party, and by the way, if you look at the South African economy, it's absolutely, utterly dire. Well, of course it is. It's run by communists. The ANC party is seeking to nationalise the central bank, to swap its inflation mandate, because remember, the central bank's primary focus should be security of the currency. Unfortunately, many central banks have a twin objective, which is security of the currency as well as security of the economy and jobs. You cannot do both in a deflationary world. We are naturally deflationary because of technology. However, the South African communists want to swap the inflation mandate of the Reserve Bank of South Africa for, quote, socio-economic well-being of citizens, unquote. Now look at the chart. It shows the dollar against the South African rand. Now you'll see that the dollar has actually fallen during 2016. You will see that since early 2017, the dollar has been rising, or at least it's got a higher low against the rand, and indeed the dollar has broken up above resistance, the falling trend line, against the rand. Now, what you can't see on this chart, you can only see 2015 onwards, is that the dollar absolutely soared over many years against the rand. In other words, the rand devalued against Western currencies. Only in 2016 did the rand strengthen against Western currencies, but it has proven to be temporary. What we will now see is that the rand will absolutely debase. And you know that other wholly communist country that we talk about, Venezuela, heartbreaking, with 700% inflation? It's coming now to South Africa. I would give it no more than 5 years for South Africa to be in triple-digit inflation and the economy in absolute meltdown. The elite, of course, will continue to do very well, because in socialism, the elite always does extremely well. In capitalism, the elite does badly, and the bottom 50% does really, really well. That is capitalism. Now, do you want to understand economics? I suggest you look at this cartoon. Guy's reading the newspaper. Oh, I see unemployment's down. That's good. No, apparently it's bad. It means there's a labour shortage. And the guy says, that's bad. No, that's good. It'll push wages up. That's good. No, that's bad. It means higher interest rates. Oh, that's bad. No, it's good. It strengthens the currency. Oh, that's good. No, it's bad. Means more expensive exports. Oh, that's bad. No, it's good. It means cheaper imports. And his mate is now perplexed and says, let's stick to the weather. Actually, this is an absolutely brilliant depiction of how the media deliberately confuses. Let me tell you categorically, listener, a strong currency is brilliant for the economy, not in the short term, brilliant in the economy for the medium to long terms and brilliant for the bottom 90%. You need to get this. What we've had in the last 10 years has been brilliant for the top 10% and has been total, utter rubbish for the bottom 90%. And unfortunately, that's what's continuing. Now, I'm heading towards economics now. And I want to start off by saying that there are many mixed signals in the economy. However, the signal that is leaping out at me right now and over the last, year and a half actually, but it seems to be sustaining, is that we have higher sustainable inflation. And this means a great deal to your pensions. Are you adequately prepared? Are you investing because we have inflation? Or are you investing because you expect there to be a hard recession and mega deflation? The first chart there is the US CEO Confidence Index. And you will see that it's on a high. It's on nearly an all-time high, commensurate with to the early 2000s, 2003 to 2006. When you will recall, the economy and the stock markets did really, really well. The CEO Confidence Index plummeted from 2007 to 2009, rightly so, and indeed it started plummeting before October 07, which was the peak in the stock market. It's still in a rising trend. So that should further suggest to us that we're heading towards when we can say recession looms. What we cannot say is recession looms. Now, there is a chart of the G20 and their deficits, the public sector borrowing requirement. Those of you listeners with grey hair will remember the PSBR. Tony Blair and Gordon Brown changed it to being called the deficit. Oh, that sounds much nicer, doesn't it? And you will see that 18 out of 20 of the G20, which incidentally accounts for some 90% of the global economy, 18 out of 20 actually borrows in order to keep their economy alive. South Korea has a tiny surplus of 0.3% of the size of the economy, the GDP, and Germany also has a surplus at 0.8% of the GDP. I can tell you, any country with a surplus is a country worth being in economically. For UK listeners, we're around the rump at minus 3.1%. We're borrowing 3.1% of our economy. Now that actually is materially lower than in recent years when it's been more like 4, 5, 6%. I don't bother with 2009-10, the last year of Gordon Brown's prime ministership, because that was the year of the massive bailouts. Of course, that's when the Tories always say, oh, we're borrowing less than Gordon Brown. No, you bloomin' well aren't. You borrowed more in the last 6.5 years. It's just that 1 year that you refer to. So the next time you hear a Tory saying we slashed a deficit, ask them what was the deficit in 2008-9, 2007-8, 2006-7. They're all the same. There's no difference. Do you know what the most striking thing about that chart is? Not that Saudi Arabia borrows 17% of its economy to keep its economy going, but the fact that the primary sponsor of global terrorism in the world is in the G20. Let's have a quick look at the United Kingdom. Economically, it's the fifth or sixth economy on the planet. I don't see that particularly important. I suppose it is very important that we have enormous reach through the Commonwealth. There's no question that once we Brexit, our strength with the Commonwealth will be brilliant for Britain. But in terms of our importance in the world, whilst we remain part of the global banking cartel and we just basically do whatever these guys want and continue to borrow and spend at will and so on, we're really insignificant. We're changing nothing. It's shocking, he says tongue-in-cheek, that Britain is now in the midst of its worst decade for economic productivity in 2 centuries. Well, what the hell do you expect when you have an economy based on debt and house prices? For goodness sake. And this chart shows that our productivity has actually gone negative for the first time since the late 18th century. What's the source? The Bank of England. Now, I've got another chart. Yeah, there it is. The UK savings ratio has now fallen to an all-time record low. We are now saving just 1.7% of what we are earning. It's the lowest in history. And the chart shows you back to 1980 when we were saving 15%. Even in the depth of the biggest recession in decades in 2008, we were still saving over 4%. And listener, we're saving 1.7%, and this is before the recession. Now, remember, the economy is not the market. So we see stock markets, particularly the US markets, at near all-time highs. Okay, they've come off a few percent. We see the FTSE and the DAX at near all-time highs. Okay, they've come off a bit and so on. But when we see savings ratio and productivity, and we see only the top 10% doing well, this is why, and then we see the GDP. We haven't had a 3% year in GDP growth for well over a decade. This is why I say to you, the market is not the economy. And as another indicator, look at Venezuela. They've got 700% retail price inflation. Can you imagine it? Can you imagine 700%? At the beginning of the year, a loaf of bread is £1. At the end of the year, a loaf of bread is £7. A basic staple of life. This is how the bottom 85% are experiencing life in Venezuela right now. And yet, 2 years ago, the stock market was at 10,000. What is it now? 120,000. Do you think the bottom 85% were or are invested in the stock market? Of course not. So inflation is what I'm moving on to. And I've got a number of things to consider here. Firstly, you've got the Chinese bond market. The chart there is the last few years of the Chinese government 10-year borrowing rate. And it's been falling for years until a year ago, when it bottomed at, as you can see, about 2.7%. It's now up to 3.7%. This means that the bond markets in China see inflation in China. And if China is inflating, then they are going to send that inflation to the rest of the world. And indeed, in the last few months, we've seen the Chinese currency rising, which means it costs us more money to buy all the stuff that we buy from China. Thus, China is exporting inflation to the West. What else have we got? The European Central Bank is probably going to end loose monetary policy this year. And, I've been talking about this for months, that it was likely to happen. Their input costs are rising at an excess of 5% per annum. Germany can't afford this. I mean, that would be, that's another reason why China is experiencing inflation, because Germany is exporting inflation to China. Germany wants to put a stop to this. Look at the 30-year Treasury, US Treasury Total Return Index. You can see that the government bonds in America have just risen for the last 20 years, in fact longer. But look, literally in the last several months, the price of government bonds has fallen below the dead straight rising trend line. What does that mean? It means that if the bond markets are selling government bonds in the US, they're fearful that inflation is coming down the pike. We should listen to the global bond markets. This next chart shows the US 10-year rate over the last 2 years. You see that going into the middle of last year, the 10-year borrowing rate continued to fall as it had been for years. But then it sharply rose in the second half of last year. That's the blue line. And it seems to me that after a correction, it's rising again. Look at the red line, which is the ratio of the price of copper to the price of gold. You can see that ratio of copper to gold has done practically exactly the same as the US government borrowing rate. And look, the ratio of copper to gold has broken up again in the last couple of months. It looks to me as if the 10-year rate is following it. When copper rises compared to gold, this is inflationary, folks. Don't deny facts. Some of you will be gold bugs. And I was uber bullish gold March, April, May, into early June. And then in early June, I said, stop. Gold has been rising well, but it's now going to pull back. And indeed, it pulled back from $1,300 an ounce at the beginning of last month. And today, it's about $1,200. And for the last few weeks, every single show and every tweet that you've seen from me has been gold is correcting downwards. What did I put out in my Twitter feed this morning, the 10th of July? If you're short gold, close your shorts. Gold, silver, miners are now going to have a bounce. The thing is, very short term, gold bouncing is actually deflationary. So I've just spent a few minutes talking about inflation And I've given you a number of indicators as to why the markets, why we need to see inflation, because the markets are telling us there's inflation. There's one other chart. I'm putting it out there now. It shows globally, government bond rates have broken up above important resistances, falling down trend lines. And when you see such unanimity across America, Germany, Japan, Britain, you are seeing global bonds being sold off. So if you're heavily in government bonds, you seriously might want to reduce your exposure, because the markets see inflation. So I've been talking to you about inflation, but I'm now saying we are seeing gold for a bounce, which incidentally is normally associated with deflation. To which you're saying, oh, Jonathan, make your mind up. No, you don't get it. Markets don't go in a straight line. And also sometimes they do extremely strange things. What I'm saying is intermediate picture, bigger picture, inflation. Small picture, a bit of deflation. Government bonds likely to rise very short term. Gold, silver miners likely to rise very short term. $1,300 an ounce down to $1,190, $1,210 an ounce. I'm now saying close your gold and silver and miner shorts. GDX, the gold miners index, all the way down, it's gone to 2021. It's going up to 23. Now I know that's only 10 or 15%. But at 23, we'll know a great deal more. If it breaks up above that, then yes, it's probably going to go up hundreds of dollars. That is gold, I mean. And gold miners would go up 50, 100, 150%. But you know what? It seems to me gold is in a falling trend, and it has been since last summer. Similarly, government bonds are in a falling trend, and they have been since last summer. Nothing goes in a straight line. So enjoy the bounce in gold, etc., and government bonds, but be ready to reduce, because we're not talking about a reduction for a month or two. We could be talking about a 20 to 40% crash. We could be. Another reason why I'm thinking gold's going down is because the number of short positions has risen dramatically. In April, it stood at 41,000. In May, 51,000. In June, 63,000. In July, it's now 96,000. When short-term speculators get so bearish, of course, because they're following the market, then I'm telling you, it's time to do the opposite. Look at the yen and gold chart over the last several years. They are almost identical. When the yen rises, gold rises. When the yen falls, gold falls. Big picture, the yen is looking weak. Gold is looking weak. If they both break those lower red support lines, I tell you, there is no reason at all to be in gold and anything associated to gold. Silver, 15-year chart, it actually broke the 11-year support line. Now, as I say, you're likely to see a bounce up, but it's clear that that support line is hugely important. Now, if I'm totally wrong about this, and silver doesn't about turn, it goes back up above the support line and then takes out 18. Well, do you know what? it's on its merry, merry way. But there are just too many things suggesting it's not going to happen. Well, we'll see what happens. I'm not saying I know the future, because I don't. What's the next thing I want to just mention? I'll just mention it in passing. Obamacare. The socialists and the Democrats, the socialists in Britain and the Democrats in America, they tell you Obamacare was the greatest thing since sliced bread. Total and utter lies. Look at Medicaid, which is basically security health spending. In the 1980s, America spent $35 billion a year. In the 1990s, America spent $65 billion a year. In the 2000s, America spent $170 billion a year. And in the 2010s, on Social Security healthcare, America is spending $350 billion a year. Now, off the top of my head, that is something like £300 billion a year. America's population is about 6 times ours. So the equivalent, therefore, is that they're spending £50 billion a year on basically free healthcare. To which you think, well, that doesn't sound too bad, except it only covers 50 million people. Our £120 billion a year covers 65 million people. So they're spending an absolute fortune, £300 billion a year on 50 million people. And who are the beneficiaries? The nurses, the doctors, the hospital administrators, the healthcare industry, the pharmaceutical companies. You think the Social Security beneficiaries are the beneficiaries of this? You've got to be kidding me. And let me remind you, making mathematically unsustainable promises to buy votes always ends in tears. Just ask Greeks, Puerto Ricans, Venezuelans, South Africans, and so on. Interesting snippet on the housing market in the UK. I see that 50,000 interest-only mortgages are maturing every year and will do for the next 5 years. So think about that. People took out interest-only mortgages years ago. If they did it 25 years ago, it's not a problem. They can pay off that mortgage. But if they did it in the last 10 years and they haven't built up any savings, which you and I know, we both know, they haven't built up any savings, we're hearing anecdote after anecdote of a person who is being forced to pay back the mortgage. They're not being given any more time, and they've got insufficient income, so they can't remortgage. They have to sell the house and pay back the mortgage. Now, of course, buying 10 years ago, they've got equity. Maybe even buying 5 years ago, they've got equity. But what if you're a retiree and you want to do a home equity plan? You want to take equity out of your home and you've got an interest-only mortgage. You can't do it. Now, you know, this is one of the many major issues in our housing market and why it's so devastatingly bad. People were allowed to borrow with abandon, and banks and building societies were allowed to lend with abandon. Well, you know, the chickens are coming home to roost. And the idea that the chickens would never come home to roost, well, that was the most ridiculous thing. People are going to be hurt big time by what's coming in housing. Not just because of interest-only mortgages, but so many other things. And particularly, of course, because I do see house prices have very likely peaked now for a generation, and they will fall, therefore, for a generation. How bad's that going to be for the economy? And how bad's that going to be for real people's lives? But, I have little sympathy, because I am one of the few people in the country, if not the world, who has been shouting from the rooftops and being laughed at and sniggered at, to my face, but largely behind my back. And it's affected me professionally, because imagine being out there saying, you don't want to invest in housing, you don't want to trade up because it's going to go into a long-term bear market. Well, you can imagine how that affected me professionally by being known as the wealth advisor who said, don't buy property. Now, I never said sell your own property, but I did say you want to get out of excess property, and you don't want to trade up, and you don't want to buy. I have very little sympathy for the people who are going to be hurt hard by this, because they're the ones who have been sniggering at me and people like me. And some of you too, I've little doubt. You really need to be tweeting about this show. You really need to be telling people about this show. People who are up to their eyeballs in mortgage debt, if we go into recession, they're going to lose their home. It's not going to be that 2008 when the deal between the banks and the politicians and the Bank of England was, you give us the banks vast amounts of money, we won't repossess the little people. Well, they'll blooming well repossess this time, because there will not be the same amount of bail-ins that the bailouts as there was last time. Oh, by the way, there will be bail-ins. We'll talk about that another time. I see that between 2024, which is only in 7 years' time, between 2024 and 2033, 1.1 million interest-only mortgages will mature. Now, if I'm even half right, house prices have peaked and will not rise between now and 2024, indeed 2030. How difficult is that going to be for folk who haven't reduced their mortgages and who haven't had major wage rises? Secondly, if I'm really right and house prices actually fall, join the dots, listener. Now, I've been telling you about how things are difficult in the economy. But it's mixed messages. CEO confidence levels are near all-time highs. So here's another mixed message. I've been talking to you about US auto sales, and I've been telling you about how that market is totally dire. And, it's a sizable part, as you well know, of the US economy. Well, it looks as if US auto sales have peaked and have fallen dramatically. Well, that we know for a fact, but it looks as if they're going to continue falling. By the end of last year, they were running at the rate of 18 million new cars sold per annum in the US. Only 7 months later, we're down to below 16.5 million. It's practically a 10% fall in well under a year. And that, I believe, will continue. I wouldn't be at all surprised to see it heading now towards what we saw in 2008. And the chart is there. Have a look. US auto sales absolutely plummeted to tiny numbers. A half, in fact, by 2009 of what had been selling in 2007. And it wouldn't surprise me in the slightest if that's the trajectory that we're on now in the US. And by the way, as I've said before, the UK is only 3 to 6 months behind the US. Going back to the mixed messages, there is a chart from the Federal Reserve Economics Department, Fred, and it shows 4-week moving average initial claims. In other words, lost jobs, people going on the dole. And the grey column is when the US, and therefore basically everyone else in the West, went into recession. And you will see that it's only when the 4-week moving average of initial claims actually rises that you can almost set your clock. Soon after, or within months, more or less, the US goes into recession. The moving average of initial claims is still falling. Now, sure, the rate of fall is reducing, but it's still falling. So again, I say to you, we are not seeing a recession looming. All I can say is we are closer to when we can say we can see a recession will loom. But a recession is not looming at all. But there are major problems in the US and indeed the Western economies. I've covered gold and silver in great deal. I've covered government bond yields. And then again, I go back to the economy is not the market. Look at the chart of the global stock market ex the US. It's at all-time highs. It's at all-time highs. It's back to where it was in 2015, 2014, and 2008 before the absolute crash. Now, it may be that we're at a peak again. But there are other charts to suggest that actually we've broken above long-term resistance. The FTSE has, the DAX has, the US markets did a long time ago in 2013. There are too many questions. What I would say to you is, why fight the market? Invest in things that the market is investing in. The market's got a lot more money than you do, so why fight it? And if you follow my tweets, my personal tweets, you find me at Jonathan Davis, where the O is a 0. Or indeed, I often retweet at Booms Busts Show. If you follow my tweet, you will see hard evidence of what the market is investing in. And those are the things you should be investing in. As I say, bigger picture, it looks like government bonds are in a downtrend, as is gold and the like. It looks like emerging market shares, developed market shares ex-US are on an uptrend. The US, I'm not worried about too much right now. Why be invested in things which are a bit vague? Invest in things which are clearly in a rising trend. US natural gas is hot to trot, and you can invest in it through commodity EDFs, or you can invest in it through energy companies. Global energy stocks, they're looking hot to trot. Companies in the soft commodities, in other words, agriculture, they are looking hot to trot. They've had a torrid time. They are looking hot to trot. There are many agricultural funds in which you can invest. I've talked at length about uranium miners. Why invest in things that the market isn't investing in? And at 51 minutes, I'm coming now towards the quotes of the week. But I want to just point something out to you, listener, and I want you to listen very carefully. There's a fine line between a numerator and a denominator. And only a fraction of you will understand that. The great Friedrich Hayek Nobel Prize winner for economics, or whatever they call it. There isn't really a Nobel Prize for economics, believe it or not. And he was a joint winner because they couldn't bring themselves, the socialist numpties that run the Swedish Nobel Prize. They couldn't bring themselves to give one of the greatest economists of the 20th century the prize on his own. And of course, he got the prize for work that he did basically 40 years prior. And this guy struggled to get work in academia because academia hates Austrian economics. It hates anything which doesn't say what's the mathematical model or how much are you borrowing. Do you know the economics models of the academics and of the central banks? Do you know they practically don't bring in bank lending into their models? That's how corrupt the system is. Friedrich Hayek. There is all the difference in the world between treating people equally and attempting to make them equal. I finished the quote. When you try to make people equal, absolute abject inequality is what results. Will Spencer said, under capitalism, man tries to exploit man using voluntary exchange. Under socialism, man exploits man using government force. Doesn't it just? Now, the Chief Justice of America, John Roberts, went to his son's graduation, and this isn't really about capitalism, but it's pretty impressive. John Roberts. From time to time in the years to come, I hope you will be treated unfairly, so that you will come to know the value of justice. I hope that you will suffer betrayal, because that will teach you the importance of loyalty. Sorry to say, but I hope you will be lonely from time to time, so that you don't take friends for granted. I wish you bad luck, again, from time to time, so that you will be conscious of the role of chance in life and understand that your success is not completely deserved and that the failure of others is not completely deserved either. And when you lose, as you will from time to time, I hope every now and then your opponent will gloat over your failure. It is a way for you to understand the importance of sportsmanship. I hope you'll be ignored so that you know the importance of listening to others. And I hope you will have just enough pain to learn compassion. Whether I wish these things or not, they're going to happen. And whether you benefit from them or not will depend upon your ability to see the message in your misfortunes. Chief Justice John Roberts. Pretty impressive, huh? Listener, thank you so much for listening. Email me at jd@theboomsandbustsshow.com. Tweet me at boomsbustshow. I've had an absolute blast. I will see you again next week.